I'm glad you're with us right now. Very pleased to welcome back to the show David Bensimon. I'll just let you know, David is joining us live from Singapore, so there's a slight delay on the line. We just want to be aware of that. First of all, David, thanks for taking the time. I know it's just past midnight where you are, so much appreciated.
Hey, Mike, it's always a pleasure talking with you.
Let's just start very quickly here with all the shenanigans that's been going on in Washington. You know, I mean, you're obviously, the world was watching it, but to me it was a lot of much ado about nothing. How does that factor in to your kind of analysis, or do you just say, not important?
No, fundamentals are always important. You remember the analogy I gave of the fundamentals telling us whether we're going north or south, and then the technicals can tell us where the intersections are. So certainly the shutdown and the debt ceiling issue were both important. I'll spend a moment on each of those. The shutdown, did have some moderate negative effect, but not to a large scale and not long-lasting. It does have, I think, a small silver lining, actually, in that it helped wake people up to the fact that a lot of what government does is not necessarily really useful stuff. But on the other hand, there are a few things that governments do that do have a useful and beneficial effect, for society at large. So that was just sort of a side bit about that. The real story was, as you know, the debt ceiling, and I think there are three short points that I'd like to make about that. The first is, it was astonishing to me throughout this whole several-week period of the debate from all the political players on all sides. It was just astonishing to me that they totally missed the most crucial issue, and they were focused on a single tree, rather than the forest as a whole, and that is that the decision on whether to raise the limit or the necessity of raising the limit was really not the key point. And all of the fear-mongering about what happens if you default or don't default and the necessity of raising the limit misses the point that the key was to reduce spending so that you're not at this limit. And if I give an analogy, a simple analogy that everybody can understand, you have a credit card, you have a credit line associated with that card, you go out and spend and indulge yourself and buy whatever you want and you use up the whole limit. You don't normally go back to the bank and say, hey, you must raise this limit because I want to keep on spending, whether you have income or not. You don't get to raise your limit just because you want to spend even more. The correct solution is that you go out and cut your spending or generate more revenue, more income. And the governments do have several ways to generate income. They can either raise taxes on take a bigger slice of the existing pie, although a lot of evidence around the world shows that doing that actually shrinks the pie, or they can hope to grow the pie and get a naturally larger piece of it. But this brings us to the second point, and that is that the administration in particular made a lot of threats and hype about the default and how even being late to pay some bill is going to default everything. That was really overblown. And the reality is that default, from a very strict point of view, really is only applicable. It only applies in the case of formal financial obligations like treasury bills and treasury bonds in relation to the interest of the principal that would be due on a certain date. And if you don't pay that, then sure, you've defaulted on those formal obligations. But all of the discretionary domestic spending, which amounts to a promise to give some gift to someone who thinks they're entitled to it, or also includes, let's say, commercial purchases for regular invoices for things that the government salaries. Sure, those are obligations, but they are being late in a payment is not the same as being in default on a bond. And the most important point really going forward is the third point, and that is that the total amount of interest that is payable at the moment on the $16+ trillion of debt by the U.S. federal government amounts to about $400 billion a year. So that is about 2.5% effective average interest cost on that existing debt. Now, of course, that covers the whole spectrum from practically 0% at the short end, which rolls over very frequently, and higher interest rates at the longer end, which has been outstanding for some time and doesn't roll over quite as frequently. But on average, it's about 2.5%. amounting to $400 billion. Now, that $400 billion is about 1/10 of total spending. I mean, they're sending out $4 trillion a year and only taking in about 3 to 3.5. So the interest is about 1/10 of the total. The problem is not right now, and this is why in my most recent report at the beginning of October, I actually wrote that I did not expect there to be any default, and that I did expect that they would kick the can down the road by finding a solution to raising that limit, because it's too early yet. The U.S. government, for all of its problems, is not actually at a crisis point in terms of ability to pay what they owe. That is, there was no danger yet of having an involuntary crisis of a real default. Now, that's not to say that it's not going to happen. And I do think that by the time we reach 2017 to 2022, which is really only 4, 5, 8 years down the road, what you're going to find is that if interest rates move up to an average cost of, say, 5%, which is still below historical levels, but you move up to an average rate of 5%, and that outstanding debt rises to about 20+ trillion, you're going to find that 5% of 20 trillion is $1 trillion a year in interest. And it's no longer going to become a case of guns or butter. It'll be neither guns nor butter, as everything gets sidetracked just to pay that interest. And eventually it crosses a threshold where it triggers a runaway effect of just inflating that amount of debt, inflating that amount of interest, and the dollar collapses, and eventually there will be a real crisis. But we're not at that point right now. We're still in a normal phase. It was dealt with. It's kicked the can down the road. So we can focus on the markets themselves, and we can focus on normal life. But in somewhat later part of this decade, we'll have to deal with a real crisis.
You've sort of led in, and time is so short here, Dave, but you've led into my next question in a little bit. Just because you were one of the, if not the first analyst, I think of you, I think of Don Cox, talking about the revival of the commodity sector, and I'm talking about in the late 90s. And you talked about a prosperity-driven bull market in commodities, obviously correct, as I say. But, now we have virtually all commodities, just a few exceptions, in significant downtrend moves. You look at their charts, they're clearly going downstairs. And I want to just not get too long into this before I get specifics, but bottom line, is the commodity bull market over?
The short answer is no, and I think that over the past year, particularly, we've seen gold adhere to a rhythm extraordinarily well. You'll remember, and the reason that that's important is that we can identify where we are in that rhythm and how that rhythm will play out based on the confidence that it is adhering to a particular pattern. You remember, I stood in Vancouver with one of your events, I think the evening with Mike Campbell in October 2012, at a time when the market was incredibly bullish about gold. We were bumping up to 1,800. Everybody was lifting the horizons to 2,000 plus, looking for new highs. And I stood there and I said, no, 1,800 then and there was going to be the top, and it was going to fall 20% over the next 4 or 5 months to an initial target of 1,440. The market, in fact, did reverse directly at 1,800, fell at about 15%, didn't quite reach the price level by that end of that time period. And in that next report, when we were at 1,600 still, I said that in that particular case, and the structure that was evolving, price was more important than time. It's not always the case, but in that case it was. And that we had another 20% to fall from 1,600 to the secondary level at 1,280 on 14th of June. And a few weeks later, we gave the next presentation, your Gold Summit, which was very nicely timed. And I said that the downtrend was intact, the targets were intact, and we would reach, extremely likely, we would reach 1,280 on schedule in June. And sure enough, the market did tag the 1,280 level. It reached it on the 21st of June, just a week after the original specified date, for a total of about 30% down from the 1,800 level, a $500 plus drop in gold. And over the next few days, it stretched a little bit lower to 1,180 on the 28th of June, which everybody's familiar with. But what's important was, right on the day when we reached 1,180, I looked at that, and some people might say, oh, we've gone below 1,280, therefore something new is happening. But I did the calculations because you have to always reassess whenever you reach new intersections or new levels or new developments. And I did the calculations, and I discovered that 1,180 on precisely 28 June had an important and very significant juncture of support. And so I issued a new special report on gold, the first in a new series, which said that it potentially could be the bottom of the market, or at the very least, it would be a base that would give us a very strong recovery, even if later it had to come back and retest it. But at that point, at the end of June, it was a very sure, high confidence point that it was going to rally. And I said it would jump at least $150 to $13.30. A couple weeks later, extended that to $13.50 with the next timing window on 26 July. The market, in fact, reached $13.50 precisely on the 23rd of July, and then fell back halfway. Now, at that stage, we again reassessed the market, and I wrote in a new report that the market was in a no man's land. And so I gave several scenarios. I said, if the market is triggered by certain movements above a level, or it's triggered by movement below a certain level, that would give you that would invoke a scenario in that direction. And specifically said that if it went above that 1350, 1360 area, it would move all the way up to 1440 on the next timing window of 30 August. And I think, it's important to note that timing windows are independent of polarity. That means from a pure timing perspective, 30 August could have been a high or could have been a low, depending on which way it was trending. But if it happened to be going up, then it would turn out to be a high. It would effectively mark a turning point from whatever was. So the forecast was it would reach 1440 on 30 August, and we got pretty darn close with 1433 on the 28th of August, a few dollars shy and a couple days early. The next report then said, just to help your audience to understand where we are in the rhythm, I identified the fact that from that high at 1433, the market had to consolidate between upper and lower bounds, 1430 being the upper edge, 1300 being the lower edge, and the center of that zone being 1365. And that it would oscillate in that zone as it tried to decide whether the bottom at 1180 in June was the real bottom or whether it needed to make a lower low. And in fact, the market did immediately plunge right back to 1300 and even poke a little bit below before bouncing up to where we are here at around 1320 or so. Now, the most recent report that I've done on gold was part of the quarterly series at the beginning of October, and had so many people, and that report included S&P and oil as well as gold and silver, but so many people asked me about the gold and silver that I extracted those sections into their own separate reports, unique to just each market. And the conclusion that I drew in this current report is that the structure of the market, having gone up in this very clear ABC pattern from June, where you went up 170, down halfway, and then another almost 170.
It looks like we've lost David here at this point. So, David, we've just lost you on that. So I'm going to take a break. I'll come back, reconnect. We're right at that. We're right at the crux of it, where we think we're going at this point here with David Bensimon, PolarPacific.com. I'll ask him quickly about silver. I'll go to this, the markets too. All of that coming your way on Money Talks across the Chorus Network. Just a reminder that next week I will be in Calgary Sunday. You want to make time to go there. Just go to moneytalks.net for tickets, but Jack Crooks is going to be with me. Victor Adair is going to be with me. We're going to talk the currency markets. Also, a whole raft of other terrific speakers. Andrew Rulin, Chad Wazilenkoff, Tyler Bullhorn's going to kick things off for us. Rob Levy's going to be there. Drew Zimmerman's going to be there. Steve Duchesne. So make time for it. It always kills me. It's a nice Sunday there. You can learn a lot of stuff, and I hope we tell you how to make some money. Speaking of that, I've got David Bensimon on the line. As I explained, he is joining me live from Singapore, and you can find David at PolarPacific.com. David, we just lost connection there. You were just coming, but we got so much to cover here. You're just coming to the bottom line on gold from this point forward.
Yes, exactly. And I am now very bearish, in fact. And the point is that so long as the market is below that midline at 1365, you have to treat it from a bearish perspective. If the market were above 1365, you would have to treat it from a bullish perspective. But you really have to, you can only confirm those very large eventual movements once you break free of the triggers. So in the downside case, it's below 1300. In the upside case, it's 1430. But I am bearish, and even more so for silver. Now, you remember when I stood there last year, when I said the sentence that silver was going to drop 40% from 35 to 21, I can distinctly remember the audible gasp of the audience when I said 40%. But the fact is that silver is a volatile market. The scale of movement going up over the decade was 1,150%. And there were several cases along that way when you went down by 40% or more. And even since 2011, we've had several instances of 40% drops. So it's really not out of the ordinary scope for movements in a market like silver. The point, though, is that from the recent high at 25, I do think that there is the risk of another 40% drop, and in fact even a little bit more to a particularly strong juncture of support during this fourth quarter on a particular date at a particular time. And although I have to save something for the clients, I will give a hint to your audience, and I know that some of them like to play with the numbers. The silver has been adhering to a really nice Lucas rhythm. Now, Lucas is that series of numbers 4, 7, 11, 18, etc., similar to Fibonacci. But it's those key numbers, 4, 7, 11, 18, which help define the magnitudes of the movements in silver, and that'll give you a hint on where it's going. But although I'm bearish near term for these 2 months on gold and silver, I'm still very bullish for the following several years to new record highs on both of those markets. And of course, in order to look at the details of what kind of price we can look for each step along the way going up, we need to first turn the corner. And in order to turn the corner, we have to first reach the termination point. So we need to be cognizant of the risks going down for the next couple of months, but we can have some degree of confidence that it's going to turn the corner and go up for several years.
I'm talking with David Bensimon live from Singapore, polarpacific.com. Polarpacific.com. David, I'm going to give you, this is going to be a nightmare for you, the 1 minute on oil.
Oil had a great recovery between 2008 and 2011 from 32 up to 115. And since then, it has been moving sideways, down and up and down and up and down and up, essentially moving across a channel. And the key about that channel is that, about any channel, is that the market can reach it either falling fast and deep or slow and shallow. And you have to look for the key price levels for where that channel will cross. In the case of oil, the normal 3/8, 1/2, and 5/8 retracements would have been 64, 74, and 84. Well, we got to 64 originally. We got to 74 in the first slide down in 2011. But that channel has now moved above those levels. And that leaves one important window of opportunity to tag 84 in December of this year as the channel crosses that level. So my report from the beginning of October was that we would fall 20% from 104 to 84. We've already seen the start of that move down to 100. I think that's going to continue over the next couple months.
Great stuff with David Bensimon. I'll take a break. I'm going to keep David a couple more minutes. Remember, you were talking about it's well past midnight in Singapore right now, but I'll ask him about the stock market when we come back with David Bensimon, polarpacific.com. In the meantime, a reminder, our shocking stat of the week is coming up with Mark Milkey. Tax me, I'm Canadian. I've got Victor Adair. I've got a Goofy Award for you. And another reminder, take the break, go to moneytalks.net. I want to see you in Calgary this coming weekend with Jack Crooks and Victor Adair talking how to make money in currencies and so many other great speakers. Make the time to do it. I'll take a break, come back, as I say, more with David Bensimon on the Chorus Network. Looking forward to it. Mark Milkey joining me in just a couple of minutes. Tax me, I'm Canadian. Amen to that. But he's got our shocking stat of the week this week. I've got Victor Adair and a Goofy Award all coming your way. But right now, very pleased to have with me David Bensimon. He is live from Singapore, joining us well past midnight there. David, thank you for taking a little extra time with us, first of all. But I just want to get a quick synopsis of where we're at in the stock markets. Pick your market.
Sure. Yep. You remember just the day before we did your gold summit, the S&P had reached a high, a then record high at 1687. And I did a special report which I offered as a complimentary copy to all the attendees and viewers. And that report called for a 130-point collapse from that 1690 to 1560. And it exactly is what happened over the next couple of weeks. Now, that continuation of that scenario was for the market to move in a triangle over the next several months, in a contracting triangle. But in a subsequent report, I highlighted that if the market moved above 1680, it would negate that consolidation zone and instead invoke a somewhat more bullish scenario that had a first level of resistance at 1730. The market, in fact, did reach a high at precisely 1730 on the 19th of September. And in the latest report, the current scenario is that I favor, on October 1st, I favored that the market would move higher, again, because I didn't expect any real problem with the default thing, and that and it would move higher until late October. Now, in fact, what we've seen between gold and the S&P lately has been a very neat inverse relationship. Now, that's not the case all the time throughout history, but for the recent months, we've seen some inverted behavior. When gold goes up, S&P goes down. When gold goes down, S&P goes up. And so at the moment, the timing windows at the end of October and somewhat later, these are representing timing windows that are joint timing windows in opposite ways for the S&P and gold. So in the same way that I'm expecting intermediate lows for gold, I'm expecting intermediate highs for the S&P. But once we reach these levels of resistance that are somewhat higher than where we are over the next couple months, I do expect that the market would consolidate and pull back from there, but I am very confident that we're going to see 2014, 15, and 16 very bullish for stock market globally, and at that point we resynchronize gold and S&P so that they are able to move up together. But for the moment, we're still in this transition phase where they're moving in opposite directions.
Well, and as I say, if you want more on David's stuff, and as I say, I always enjoy reading what David is writing. It's so thorough. He's not, I mean, doesn't, on the radio, even in person, it's hard to do justice to the depth of the methodology that David is using, but he's done a wonderful job summarizing what he sees going forward. You just go to polarpacific.com, polarpacific.com, and as I say, great stuff out of David. David, thank you so much. I know you've got a new baby just a few weeks into that, so you probably haven't been sleeping anyways, and here we are taking some valuable sleep time, so thank you.
You know what, Mike, it is a whole new world of discovery for me, as I'm sure it is for the little guy, but it is a wonderful new experience. Thanks very much.
Okay, well, thank you for finding time with us. David Bensimon, live from Singapore, polarpacific.com. I'll take a break. I'll come back. Mark Milke with our shocking stat of the week. To this today, so let me just remind you, I'm in Calgary. I'll broadcast, of course, on Saturday, but on Calgary next Sunday, 9 a.m. to 3 p.m. We have a whole group of speakers: Tyler Bullhorn, Steve Duchesne, Drew Zimmerman, Rob Levy, Chad Wazilenkoff, Andrew Rulin, talking about financial stuff. And then we have a special VIP. That's free, by the way, that the 9 to 3, and then at 3 o'clock we have a special VIP. We're bringing up Jack Crooks from Florida, Black Swan Trading. Victor Dare is going to come in from Vancouver. And I just think you can't miss this. You've got to be exposed to exchange-traded funds, which Steve Duchesne is going to help us with, and then come and talk about, I mean, the action in the currency market is one of the great weapons you have for your investment growth. And you should at least come and get a feel for it. That's all I'm saying. You know, come and be introduced to it. So all you have to do is go to moneytalks.net and click on and get all the info and the tickets. But really, come on, be there. Right now I've got Mark Milke helping me out for the next couple of weeks. I'll tell you how this started. As you know, I do a shocking stat of the week. Well, Mark's got a brand new book out. It's a follow-up to one he wrote, I guess, about 10 years ago. And it's called Tax Me, I'm Canadian. And I can hear some people going amen to that, certainly feeling that issue. But it's out just in the mid-September, so it's just out in the bookshelves now. You can get it off of Amazon also. And it really is a chronicle, and it's very tough to get this information, a comprehensive chronicle of the tax burden that Canadians face. And clearly I want to acknowledge there's some Canadians who wish that burden was higher, at least on other people. And this is just such a great reference book for me when I look at it and get a real feel for the myriad of ways that Canadians are contributing to government. Mark joins me on the line right now. Mark, first of all, congratulations on the book, Tax Me, I'm Canadian.
Thank you, Michael. Thanks for having me on.
I'm going to start with this week's shock and stat of the week with you, though, because it's right up your alley. We've just had word of, Canada signing an EU trade agreement, European Union trade agreement. And one of the real issues there, and it's not just because of that agreement, but it brought it back to the forefront, is about the people don't get the taxes or the tariffs they're paying that boost up the prices of dairy products.
Right, and one of the things people don't know is they don't see these hidden tariffs, right? They see the GST, they see the HST at the till, but they don't see these hidden tariffs. And so if you look at the kind of tariffs we impose on products from outside the country, right, it's a tariff wall, really. It keeps out products. But anybody wants to import a yogurt, for example, above some predetermined limit, 238% tariff or tax. I mean, that's what a tariff is. Milk from outside the country, 241%. Cheese, 246%. Goes all the way up to butter at 299%. I mean, imagine if these products came in and at the till, the tariff slash tax was applied then at 299% on imported butter. People would, they would riot over butter, I suppose. But most people don't see this because it's not visible.
What a great point, though. If, in fact, we went to the till, and, I'm just picking a number here, and, half kilo of butter costs $2. You go to the till, it says, here's your $2, and we're going to add on, I guess in that case, $6 worth of tariffs, worth of taxes. People would go nuts.
Right, they would. And again, these tariffs really serve as a barrier. And I mean, we won't get into marketing and supply boards today or all of that. But I mean, these are designed as protectionist measures to quote unquote protect domestic industry. Even though there's a great case to be made for getting rid of these tariffs and opening up competition in the sector for two reasons. One, you would actually promote export growth among Canadian dairy farmers. As has happened elsewhere in the world, New Zealand, for example. And two, these high tariffs, of course, and the attempt to keep prices up in the dairy sector hurt who most of all? Well, they hurt the poorest Canadians most of all because low-income Canadians, by definition, of course, are spending most of their disposable income on what? Rent, shelter, food, right? So that's the problem with these sorts of high tariffs, and they're just only one example of the kind of taxes we pay, hidden or visible.
Give me just a couple of other quick ones. They don't have to be so totally hidden, but I mean, I'm thinking in terms of, I don't think people are aware of how much we have in terms of liquor taxes.
Right.
Just stuff like that.
Sure. Liquor taxes, again, are hidden, and there's massive markups there. There's all sorts of other taxes, which people may or may not be familiar with. Airport security tax, airport navigation tax, a tire tax, an excise tax, a personal surtax, depending on the province you live in, property tax, of course, if you own property, goods and services tax, and the HST, which almost everyone should know about by now because it is on their receipts, provincial payroll tax, liquor markup tax, a customs tax. I mean, one could go on, an air conditioning tax. So some of these are visible, some of these are not so visible, but they all contribute to the tax burden in ways that make it equivalent to almost 4 out of every $10 in terms of receipts to governments as a percentage of the economy these days. And that's actually slightly higher. This is one of the things I found when I was researching Taxman Canadian. That's actually slightly higher than the portion of money as a percentage of the economy that went to government back under Pierre Trudeau.
Well, the other thing that it's one of my things is you've already mentioned one of them. I just think it's outrageous the number of times we have politicians, special interest groups pay lip service to the poor. Lip service. Then you look at the actions. And the actions, as you started out here today with our shocking stats, it means that yogurt, over that level is 238% higher than it need be. Milk, 241%. Why do you think people cross-border shop here? Skim milk, powder. Gosh, 246%, as you pointed out, Mark. The list just keeps going on. And who does that impact the most, as you say? And so that's one of my things. The other is how inaccurate much of our discussion on taxation is. Why? Because it only focuses on income tax, sometimes sales tax, but income tax and corporate income tax when there's this myriad of other taxes that we pay.
Right, and that's one of the reasons in the book, in Tax from Canadian, I look at not only the taxes that are collected, but how they're spent, because that's the other part of the equation, of course. I mean, you can make an argument for that some taxes are quite sensible. I mean, I think a toll tax on highways makes sense, because then even visitors to the country pay for the upkeep of the infrastructure. So I think you can make an argument that some taxes are better than others, and economists would tell you that some taxes make more sense. But what doesn't make sense is simply to say, well, that's the price we pay for civilization. I mean, look, when that quote came out, when that quip came out from Justice Oliver Wendell Holmes in the 1920s, taxes as a percentage of the economy were a lot lower than they are today. So a lot of what Tax from Canadian about is trying to get at, well, how do governments spend money Could they spend some of it better and leave more money in our pockets? And of course, my argument and my view on that is quite simply yes, they could.
I couldn't agree more, and that's why we'll spend more time with Mark Milke. Mark, I'm not sure if I was going to say, I can hardly wait till you pull something else out of Tax Me, I'm Canadian to share with us our shocking stat next week. But maybe I shouldn't say that because I'm never that happy after I hear about it. But thank you for taking the time.
Thank you.
Great stuff. Tax Me, I'm Canadian. It's in the bookstores right now. You can get it online also. Mark Milke, my guest. I'll take a break. I'll come back. I got a Goofy Award. I got Victor Adair. Lots coming your way on Chorus Radio Network. I was smiling this week reading something Victor had written at victoradair.com and knowing I was going to chat with him. You want to know where the big returns were last week? Are you kidding me? Victor, tell me about them.
Well, in the local market, certainly Google, the shares of Google jumped $120 on Friday. That's up over 13% on the day, traded above $1,000 a share. Google is up over 40% so far this year. And the market capitalization, that is the total value of all the outstanding shares of Google, is bigger than the total market capitalization of all 5 of the Canadian big banks put together.
Yeah, that's a bit scary, eh? That gives me nosebleed. Yeah, I mean, that's an amazing stat. Like I saw the same on Friday, and it's one of those say what. And let me say, I didn't own Google on Friday, so I didn't make my $130 in a single day on that 13% jump. But also, you were writing about Caracas stock market in Venezuela.
Yeah, it's interesting, and I've done a little more digging on this. The main stock market in Venezuela, and you can imagine, this is probably nothing like the New York Stock Exchange, but it's up over 300% so far this year. It was up over 300% last year. It's, in a way, kind of reminiscent of what happened in Zimbabwe a few years ago when it was the hottest stock market in the world. It makes you think about, why would that be happening? Well, of course, there's a couple of different markets for the foreign exchange down there. There's the official market, and then there's the black market. And on the black market, the Venezuela currency isn't worth much more than toilet paper. And if you have some currency, then obviously, like in Zimbabwe, the thing you want to do is get rid of it and buy something, even if it's shares on the Venezuela stock market.
Just very quickly, Vic, I love something you said earlier on when you're talking about the Federal Reserve is sort of a given right now, that now that we've turned our attention back to what the Federal Reserve is doing, quantitative easing, et cetera. And you sort of said, I get worried when everybody's got the same opinion. They're cruising for a bruising.
Oh, that cruising for a bruising, that would be my grandmother's expression, but it's a good way to understand things here. The market, I'm very keen on where the market psychology is. The market's obviously very bullish right now. I think the basis of that is the consensus view is that the Federal Reserve will remain easy for an indefinite period. In other words, the money machine keeps cranking. And we look back over the past couple of years, the market moves up and down in waves as the anticipation changes about what the Fed will do. So right now it looks like just nothing but easy money coming our way. We've made new all-time highs in a number of the major American indices, particularly the more speculative indices. To me, this looks like we're a little ahead of ourselves, even though Google jumped over $1,000 a share here on Friday. I think that's kind of a sign that, maybe we're getting a little toppy. I wouldn't be mortgaging the family farm to jump in here. That's what I'm saying.
Great stuff. Well, you're going to be with Jack Crooks in Calgary a week Sunday, a week tomorrow.
Right. And
I'm really looking forward to it because, you've got 40 years in the business. Jack's similar. And I just think people got to come and take advantage of this, because you're going to jumpstart them in an area that I think people absolutely have to be aware of and consider. And that is, there's so many, you're going to be talking about the market rules that you've learned that made you a better investor, made you a better trader, saved you some money, helped keep you on track. And I'll tell you, that's going to be I look forward to it myself, and I've been, as you can tell by my gray hair, I've been there a little while in the markets, and the bruises, by the way. And I just think it's going to be a great day, so I'm really looking forward to hearing you.
Well, I'm looking forward to being there, and Jack and I, of course, been friends for years. I read his research every day, and I really like Jack. I really recommend Jack to people. And like all of the analysts out there that are any good, He's not always right, but he'll give you something to think about.
Yeah, he sure will. That's next Sunday in Calgary. Victor and Jack are part of the VIP event starting at 3 o'clock. Before that, we've got a whole raft of speakers, and they're free, to come and hear people like Andrew Rulin and Chad Wazilenkoff, Steve Duchesne. It's going to be there. Rob Levy's going to be there. Drew Zimmerman's going to be there. The list is huge, so I want you to make time to do that. That's why I'm imploring you. The more information, education you can get, the better it is. But you know what? Part with a few dollars. Help us put this event on, by the way, and come and hear Victor and Jack Crooks, because it's going to be a very strong event. And all you have to do is go to moneytalks.net. And there's a lot of good articles on this weekend, too, by the way, on moneytalks.net. But just click on, and I expect to see you there. We'll have to come to your house and shake you up. Time now for this week's Goofy Award. Oh, come on. Alan Greenspan. Remember him? Former head of the Federal Reserve, given a lot of credit for creating the biggest credit bubble in history. And he clearly didn't see it coming, by the way. Clearly didn't see it coming. Well, Mr. Greenspan's written a book about economic forecasting. Say what? The biggest event of the last 60 years, and he didn't see it coming, but he's going to tell me about forecasting? The book is called The Map and the Territory. And I love this, out of Bloomberg reviewed it. He said, is about as credible as art history by Mr. Magoo. Bloomberg's Daniel Ask concludes, The Map and the Territory is an infuriating book. I gotta like that. One that will leave readers wondering how its author could have come all this way and yet remain so hopelessly lost. So this week's Goofy goes to Alan Greenspan. We are still dealing with the aftermath of the fact that he created, or was a large part creating, the credit bubble and never saw it coming. So that's this week's Goofy Award. One final reminder, go to moneytalks.net every day. We've got updates on all sorts of things, everything to do with the market, but especially for this week, you want to click on the icon for the Calgary event, because I think you're going to really enjoy it. This is the thing you got to do, though. I mean, this is a chance to learn from the expertise of others and sort of bypass the mistakes they would make, they have made, and that's what Tyler Bullhorn's kicking things off. If you haven't heard Tyler, you got to come and hear him. Steve Duchesne is going to be there, great portfolio manager. So all of that coming your way. So hope to see you in Calgary next weekend. Go out and have a pleasant weekend. Thanks so much for listening.